It is the most painful experience in the world of finance. You hold a stock for months, enduring sideways movement and agonizing stagnation.
Finally, you lose patience or the price suddenly drops, hitting your stop loss. You sell.
And within 48 hours, the stock skyrockets, embarking on a massive rally that would have changed your life.
Why does this happen? Is it bad luck, or is it a calculated psychological ambush?
Today, we are peeling back the curtain on the violent washout, the most brutal weapon in the arsenal of institutional investors.
We will explore how the main force plays with your survival instincts to force you out of your position right before the moonshot.
This is not just a lesson in technical analysis. It is a journey into the dark heart of market psychology.
Act 1. The invisible war for liquidity. To understand why you are being shaken out, you must first understand the fundamental problem of the institutional investor, or the main force.
Unlike a retail trader who can enter or exit a position with a single click, a fund manager moving hundreds of millions of dollars faces a liquidity trap.
If they simply buy on the open market, they drive the price up so fast that their average cost becomes too high.
To accumulate a massive position at a low price, they need sellers. They need you to give up your shares voluntarily.
This creates a fundamental conflict of interest. For the main force to win big, the retail crowd must lose their conviction. The violent washout is the process of manufacturing that loss of conviction. It is a theater of pain designed to make holding a stock feel like holding a hot coal. Act 2. The anatomy of a washout. A washout is rarely a single event. It is a symphony of coordinated pressure. It usually begins after a long period of accumulation. During this phase, the price moves sideways in a boring, narrow range.
This is the time tax. The main force is waiting for you to get bored and move on to the next shiny object.
But for those who stay, the violent washout is the final test. It often manifests as a false breakdown. Just as the chart looks ready to break out, the price suddenly plunges through key support levels, the 20-day or 50-day moving averages. This is done with precision to trigger stop-loss orders. When these orders hit, they create a cascade of selling, providing the very liquidity the main force needs to complete their buy orders at a discount. Look at the volume during these drops. Often it is surprisingly low relative to the price movement, or it spikes momentarily as retail panic hits its peak. This is the exhaustion point. Act 3. The psychological trap. Fear and the amygdala. Why is this so effective? Because human beings are biologically wired to avoid loss more than we are wired to seek gain. This is prospect theory in action. When you see a 10% drop on your screen after months of waiting, your brain's amygdala triggers a fight or flight response. The main force knows that retail traders are most vulnerable when they are tired. After weeks of boring price action, a sudden, scary drop is the final blow. They create a narrative of failure. Perhaps they release or leverage negative news precisely when the technical breakdown occurs. You begin to tell yourself, I just want to get out and save what's left. The moment you click sell, you feel a sense of relief, the relief of the loser. This relief is the signal the main force was waiting for. They have successfully transferred the shares from weak hands to strong hands. Act 4. Recognizing the patterns. How do you distinguish a washout from a genuine trend reversal? First, look at the spring, a term coined by the legendary Richard Wyckoff. A spring occurs when the price breaks below a support level, stays there briefly to flush out the sellers, and then quickly recovers back into the previous range. This is a classic sign of institutional manipulation. Second, analyze the volume-price relationship. In a true crash, volume stays high as everyone exits. In a washout, the volume often dries up after the initial panic, showing that there is no more selling pressure left. Third, consider the relative strength. Is the stock dropping because the whole market is crashing, or is it being singled out for a hit? If a stock breaks down on no specific news while its sector remains stable, you are likely witnessing a deliberate shakeout. Historical examples, from the early days of Amazon to the volatile swings of modern tech giants, show the same pattern. A V-shaped recovery immediately following a terrifying candle. Act 5. The Zen of Trading. Survival in the market requires a shift in identity. You must stop thinking like a victim of price action and start thinking like a predator of psychology. To beat the main force, you must master your own boredom and your own terror. This means setting stop losses not at obvious technical levels where everyone else puts them, but at levels that would truly invalidate the long-term thesis. It means seeing a violent washout not as a threat, but as a confirmation that the big move is imminent. The main force doesn't bother washing out a stock that isn't going anywhere. The more violent the shakeout, the more explosive the coming rally usually is. It is the final clearing of the decks before the ship sets sail. Remember the words of Jesse Livermore. It was never my thinking that made the big money for me. It was always my sitting. Sitting through the washout is the hardest work in trading, and it is the only work that truly pays. The next time you see a stock you love suddenly tank for no apparent reason, don't panic. Take a breath, look at the volume, and ask yourself, am I being shaken, or is the story truly over? The market is a machine for transferring wealth from the impatient to the patient. Don't let them take your seat right before the show begins. If you found this deep dive into institutional psychology helpful, hit the like button, subscribe for more market secrets, and comment below with a time you were shaken out right before a rally. Let's learn from each other. I'll see you in the next one.